Stand by. Recorder starting. Welcome everybody. This is the Saturday morning Viper trading webinar. If you're here to learn about trading the futures market, you are in the right place. But first we got to get our standard disclaimer out of the way, so let's take care of that. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of loss. Nothing contained in this webinar. Other webinars, including the live chat trading rooms, are to be construed as investment or trading advice. And of course, everyone in here does know that you do trade at your own sole discretion. All right. All right, so today's topic is one and done trades. And before we get started with that, I want to just ask the team, everyone in here this morning, and I'm glad you took the time out of your Saturday morning to come join us, or afternoon, or wherever you're located. And I promise this is going to be a good one. I really want to do this webinar in such a way where when you leave here and you start looking at your charts and for trade setups, starting as early as next week or whenever you trade, that you try to think about it in such a way that you're going to be looking for just some very good high probability, low risk setups that you can just come in and you can nail some trades very quickly, get in and out, and try to minimize your exposure to risk into the markets, and try to capitalize on some movement. So before I do that, though, I want to ask the team here, in a typical trading session or day or evening or whenever you like to trade, how many trades do you normally take? Just go ahead and type in a number. In a normal session, a normal morning or afternoon or day, or whenever you trade, depending on where you're located. Five to 20? Holy smagaboni. 10, 2 to 3, 3 to 5, 5, 20 to 30. Oh my goodness. Mr. S, 6 to 10, 6 to 10. Holy cow. That's a lot of trades. That is a lot of trades. Well, let me ask a different question. That's a lot of trades. Holy cow. I had no idea it was taking that many trades. Well, I'll tell you what. I'll tell you who likes that. Okay, here we go. Roy says sometimes 1 to 3. When you're trading that much, I mean, when you're trading 10 or more trades or 20 or 30 trades, the person that likes you the most is your broker. Your broker loves that because they're making a lot of commission off of that, right? I can tell you, though, that it is possible in a given trading session that you only have to take 1 or 2 or 3 trades, 1 or 2, and you can make very good money, and you're going to pay a lot less in commissions. You're going to have a lot less stress. Your broker isn't going to like you as much because he's going to make a lot less commission, but and we're going to do this in such a way where we're going to talk about some principles here, and I'm going to get over to a chart right now. Let's do that. We're going to show you how you can do it. Let me get over to screen 1, and we're going to look at how you can just take 1 or 2 trades and be done. I'm going to come over. I'm going to cover a number of different instruments today. I'm going to look at some currencies. First, we're going to look at 6E. Come over to screen 1. Stand by. Everybody see 6E? .6E chart. Okay, those of you that are new or visiting, we have a lot of people visiting here today. Just to set your understanding of what you're looking at here. This is a 4-range chart. This is 6E. It's the Euro futures, 1250 a tick, and you see all of our standard indicators. Most of these are, some of you have seen this before. This is our Pro package, so it's got the bar coloration, it's got trailing stop dots, it's got the background colors. These are the guidance dots here. This is a 12 and a 14 guidance. You can change, you can adjust all these settings. You can make this larger or smaller. You can see we have some platinum indicators on here too with the bands. See some of the bands here, which are helpful. This is the combination that you see in the live room. When you come visit the live room, this is the setup you're looking at, okay? Now, when we come over here, I'm going to ask some basic questions, and then we're going to look at trade setups. When this market, and this is just basic price action, okay? When this market came up and it did this thrust right here, what happened to this? And let me help you out a little bit. This is recorded, Roy. Yeah, this is recorded. We're going to record this, and we'll post it up in the subscriber area this weekend. Well, we can see that, let me help you out a little bit. So we can see that over here, we were still more or less in a downtrend. Our guidance was short. However, it was very choppy. It was a choppy downtrend. And then the market came up and it took this sort of downtrend line out when it thrust up into here, like such. And it was at this point over here that we started to get some slightly higher lows and some slightly higher highs. Specifically, I'm saying these right here were starting to become slightly higher lows and higher highs. And so when we had this thrust, you could make the case that when it took out the guidance dots, that this constituted a trend change. We get a lot of traders all the time that talk to us and they say things like, well, you know, I have trouble seeing a trend change. Here you can very clearly see that this was a trend change, right? You're starting to get the higher highs, higher lows. We take out the guidance dots, and then we start to go into a retracement. Now, when this retracement occurs and the bars turn red, I'm in California, so this is all Pacific time zone. Pacific time zone. So midnight Pacific on the 28th, which would have been Friday, going into Friday morning, would have been right here. So that's the beginning of the European trading session. Is right in here. By the way, that's a good time if you're a night owl here in the States, or you. We have a lot of traders that are in the Netherlands and Germany and overseas in Europe who trade that European session. And the currencies tend to move very nicely. 6E, 6B, British Pound Futures, DX, the dollar index, sometimes the Swissy, 6S, have nice movement overnight. If you're looking for trades overnight, you know, say you work a job in the daytime and you're up in the evening time, the currencies are really nice to take a look at. 6A, 6J, we'll look at those charts in a few minutes. So shortly before the European session opened, which would have been right about here, midnight Pacific on Friday morning, so the euro started to go into a nice retracement. This is what we call a deep bar probe, because the bars turn the other color. This doesn't mean that the trend is changing back to down, because we have these swings that are in place, and now our guidance dots are down here. So you've now gone into an uptrend. Akeem, I have an EMD chart. We'll look at that too. Yeah, I'll look at crude oil. We'll look at all sorts of instruments here. Let me get through this trade first, though, real quick here. This is what we call a deep bar probe. Now you can see that we came into a very nice support area right in this band right here, and the support started to hold just below 3051. This area that it dipped down into is considered a potential buying zone. So be looking to buy support here in the case of this retracement. Now notice what happens here. We're still retracing. We draw a retracement line at approximately 45 degrees, like such. And you can see we're very clearly getting some very nice support right in this 3050 area, right in here. This represents a potential buy area. Right in here, right in here. It's chopping around and it's consolidating. Now, it's forming a very tight consolidating range. Now, some traders are, and it's maybe you, are a little nervous to buy an area like this. And here's what you can do. You see where they're starting to form a little bit of a shelf at the top of this 3057 area right here. See it? Some traders, more aggressive traders, would be putting their buys down in here. Oh, I got to put Chart Trader on. Stand by, please. 1 second. Get the Chart Trader up here. There we go. Yeah, we're in Sim. It's the weekend. Markets are closed, so we won't actually be buying anything. Some traders would be buying support down in here. This is a much lower risk trade because you're right near support, and so you can see here that your initial stop would be down, your sell stop protection would be right in here, right under the swing. See the stop dots right there? So the bottom of the support box is a much aggressive and a very good trade with low risk because you're only risking about 4 or 5 ticks on your stop. Okay. Now some traders would say, well, you know, I still don't feel comfortable buying the support area. I need to be convinced that this market's going to break up, and so some traders would be putting their buy order up in here, right up. In other words, you want to be convinced this market's going to take that out. Now, of course, your stop in that case would still be down here, but you're risking now, instead of risking 4 or 5 ticks on this entry at support, you're risking closer to 10 or 15. Much greater risk on this second trade entry. By the way, how many of you would prefer to buy the support area? We'll call it trade entry 1. How many of you would prefer to see it break out trade entry 2? Trade entry 1, more aggressive at support, tighter stop. Trade entry 2, convinced that the breakout's going to occur at the top. 1 or 2? Both are good entries. They have either, you know, you can see that the first one has much less risk, obviously. You're taking a little bit more of a leap of faith. Okay, a lot of ones, and a couple would wait till the top was taken out. Okay, they're both valid trade entries. Absolutely, both valid trade entries on 6E. All right, so let's watch what happens here. All right over in here, you can see the top of this little consolidated range is taken out. So by this point here, both trades are filled. This one is obviously filled at the bottom of support. This one is filled here. Now, let's say hypothetically, and this is really where you want to get to, and this is sort of the crux of this webinar today, is the principle of leverage. Now, when I say leverage, what does that mean? As it applies to trading. You're going to apply the principle of leverage to your trading. Taking on more risk. That's right. Now, what that means is this, that you're going to trade more than one contract. Good. That's right. You're going to trade more than one contract. You want to get to the point, if you can, with your chosen instrument, to trade at least 2 contracts if you can. Now, the reason you want to do that, there's a couple of reasons you want to do that, is no matter where you entered this trade, whether it was here, or even in the middle of consolidation, you can look very clearly at this chart. Where would be the first place that you would want to take profits? Take a look at the chart. Where would be the first place that we would look to take profits on this trade? In other words, if you put 2 contracts on the buy, where would we look to peel the first contract? It's right here. I mean, I think it's pretty clear where we would want to take profits on this trade. Just look at the chart for a second. See some numbers coming in. DL says 6.8. Williams says 8.0 at the break. 7.5. 10 ticks. Good. 7.1. 7168. Okay, good. All right, so obviously we can see that there was a double topping price action up near this 080 area right here. It is highly likely that if and when this market breaks up into this area right here, it's probably going to pause and pull back and quite possibly could retrace very deeply. And when you have a well-established swing here, and you can see there's actually a band and a zone up here, you're going to want to take profits on at least one contract here. And what we do is we fade a resistance area by at least 4 or 5 ticks. In other words, there's some likelihood that it could come and touch 80 right on the button, but we wouldn't want to put our sell order right here in hopes that it just nails that swing by the tick. If you really want to be filled, you've got to fade it by at least 3 or 4 or 5 ticks. So you're going to put your sell order down in here. Now you might say, well, I'm cutting that trade short. Well, that's true. That's a trade-off because we never know when a market's starting to break out exactly where it's going to go. Now at this point, even if you got filled here at the 60 level, the market has moved 9 or 10 ticks in your favor. What is the first thing that we need to do? And this little push higher right here, broken out of the range, and it's come up, it's coming up, it's coming up. What do we got to do? Got our target in place. Fading it by 4 or 5 ticks. Swing. That's right, we got to get our stop up. This is one of the most important things that I'd like everybody to take away from this webinar this morning is this. When this market, when any market, any trade that you take, as soon as that puppy pops up there and you've got 5, 6, 7, 8, 10, 12 ticks and it's starting to ascend very, very aggressively here, you're going to immediately take your stop up at least to break even. And if you want to guarantee that you're going to have at least a couple of ticks on a trade, you'd want to take it a couple of ticks above your entry. And I would say that would be true also of the trader that entered here. Because by the time the trader who bought this support area, by the time you're up here, let's see, 49 to 69, the trader that entered down here is now up about 20 ticks. And you would want to definitely lock some of that profit in at the top of the trading range. So at a bare minimum, the trail stop would come to here after about 10, 15 ticks of movement. Or in the case of this trader down here, 20 ticks of movement. Everybody in here, I would like to, this little move right here is going to help you so much on your trading because it's going to do a couple of things. It's going to stop those losses from happening on retracements, and it's going to start locking profits in. The other thing we want to do is locate those swing areas if you're long and plan to take that profit when it hits there, at least on one of your contracts. So let's see what happens. All right, right in here, the market pops up and takes that sell order out. So you're down. You have one contract left. You have one contract left. So we're going to take the trail stop, of course, down to 1. So we're already filled on 1, right? And let's see what happens. We chop. Excuse me. Pardon me. We chop around this resistance area just a little above it, a little bit below it, a little above it, a little bit below it, and we start to break out and we start to head a little bit higher. Now, as this market continues to ascend in your favor, and this contract is taken out, and you still have 1 on the table, you can see that the trailing stop dots are beginning to ascend in a stair-step fashion as the market continues to move up. So what we need to do is very aggressively take our stop up with the price movement, like such. Right? I see some folks are still coming in. We're going through a sim trade or a trade on 6E that's set up in the European session on Friday morning. We had a trend reversal from down to up when the guidance dots were broken. We had a deep bar probe into support at 3050. We had a couple of different trade entries, lower support, upper breakout area. We had our initial stop down here if you just came in, 3045 approximately under the trailing stop dots. As the market ascended in our favor, we brought the stop, a trailing stop up to here, locking in some profits. We took the first contract off, fading this swing by a couple of 4 ticks. And now as the market moves in our favor, we're following the stop dots up very aggressively. Market moves higher, and then somewhere in here. Now, there is a number of different ways that you could have exited this trade. I'll just quickly show what those are. Can you see here that we have a green line, which is the stealth? Okay? See the stealth line right in here? Stealth line. Some people like to fade that stealth line by a tick or two, and you can see it's a little more closer, it hugs the price a little tighter than the trailing stop dots, which are here. These are the trailing stop dots. See how they are a little looser? You also have one of the platinum bands, this line right here, which kind of closely follows the stealth. So the trailing stop, I would characterize it as sort of half art, half science. There's different ways to do it. You can see here that if you hug the price just too tightly right in here, it can take you out and leave some of the trade on the table. So you have to give it what we call a little bit of wiggle room when it's moving in your favor. That's calling letting your winner run, right? But on the other hand, you don't want to give too much up off the table when it retraces. One other final comment on this. You can see that right in here we ascended up into 3105, which was another band. This would have been another area to take profits. All right? Now, let's say that you got taken out somewhere in here. So when it was all said and done, there were 2 legs to this trade. There was leg 1, and I'll tell you what I'm going to do is I'll just do a blended average. Let's say you got filled here. So you didn't buy here, you didn't buy there. Let's say a blended average of a round number of 3055 was your fill. So your first leg was up here to 76, which is 21 ticks, leg 1. Okay? And leg 2 on this trade, on the long trade, was from here to here, which was 55 to 91. 91 less 55 is 36. 36 plus 21 is 57 ticks. 57 ticks. Well, at 1250 a tick, how much was this 1/6E trade worth for 2 contracts? Well, 57 times 1250. Let me get my little gonculator out here. 570. Yeah. What is that? 57 ticks times 1250. $712. Around $700. Now, how many of you would a $700 trade be close to or right at your profit goal for the day? 712.50. 712.50. Would that be your profit goal for the day? I'm seeing some yeses. Well, that's one trade. That's 1 2 contract trade on 6E. You entered in here. We showed several different places you could have gotten in. You took 1 contract off here, right? This very clearly defined swing area. It sort of jostled around that profit target right there. Took off. You trailed your stop up. You actually left some money on the table. I mean, it went all the way to 105. So you left about a little over 10 ticks on the table, which was an extra $150 here. That's called the drawdown, by the way. When a market starts to retrace and it finally takes your stop out. So in other words, you might have seen this trade have been up like 500, 500, 600, 600, 700, 800, 800, and it pulls back and it closes you out, and now you close out at 700, but it was as high as like 8 or 850. That's called drawdown. At the end of your trade. So what I'm saying, as it applies to the concept of drawdown is, and I know most traders try to do this, is you never get the exact bottom, and it's very rare that you would ever get the exact top. So you can see here that depending on where you entered, that we didn't get the exact bottom of where a market bottoms out, and you very rarely ever get the exact top. So you're always going to leave a little bit on the table at both ends of a trade. So all we're trying to do is capture the meat. You want to try to get 50, 60, 65, 70% of the movement. Little at the bottom, little at the top. And you want to capture the middle or the meat of the trade. And if you can, put at least 2 contracts on. That allows you to peel one and take profits and trail stop on a runner. That's a one-and-done trade. That would be a textbook one-and-done trade. So what I'd like us to do as traders for next week, if we can, especially in those 3 sessions, Monday, Tuesday, Wednesday, before the holiday weekend comes along, is to be very choosy. We're going to take, by the way, how many charts does everybody watch here? How many charts, like on your screen, how many charts do you typically have up? 1 chart, 2 instruments, 3 instruments? How many instruments does everybody in here track in a trading session? Okay, I'm seeing some numbers. Too many? You don't want to say? Four instruments, 3 instruments. Okay. That's a good number. That's a good number. What I would say is this, is that, you know, I think a good healthy number is 2 or 3, 4 charts would be more or less kind of a maximum. Because what you see is that, you know, I talk to some traders and they've got 6 or 8 or 10 charts up and you're trying to track this, and what happens is that you start to get distracted. You know, you're looking at a chart over here, you hear something to call on something over there, and then you look at a dollar chart, and the next thing you know, a 6E trade comes along. What happens then is that you wind up missing trades, and you totally get distracted. So what we want to do is we want to narrow our focus to a very small, precise set of charts. I would suggest 2 or 3, 4 at the most. And what makes it nicer is that if you can have a couple of screens, 2 screens at a bare minimum. I'll tell you that's the cheapest thing to invest in your trading. If you're going to invest anything in your trading, try to have as many screens as you can. They're all on sale now. You can get these nice big 27-inch flat screens for almost nothing. Let me show you another trade. I'm going to bring crude oil down. I want to get a couple more trades out of the way before we run out of time. Stand by. Yeah, try to have at least 2 screens. And if you can, maybe 4 charts. That's a good, healthy number, and you're not trying to stretch yourself. You're not looking at too much at any given time. All right, let's look at crude oil. This trade set up on Friday, Friday late morning. You ready? Yeah, Akeem, 4 is a good number. 4 charts, especially if you have try to get yourself a couple of nice widescreen screens, and just spread them out. And then you want to train your eye to just systematically look at each chart for a good setup. And all you're trying to get is 1 or 2 good trades on any of those 4 instruments. And you want to get so good at it that all you need to do is put 2 contracts on there, and when you nail a good, nice trade, you're done. That's it. That's all you're looking for. 1 or 2 good trades. We're going to try to limit that to ourselves next week. A good trick is this. It might sound stupid, but I'll tell you, it's worked for a lot of traders. Try to take 2 coins, put them on your desk, okay? 2 coins. Those 2 coins represent the 2 trades that you're going to take. And when they're gone, that's it. Try that. It sounds silly. I know. Just take 2 coins, any coin, 2 quarters, whatever. Put it on your desk, and it's going to make you think, right? It's going to force you to think that, hey, when those 2 coins are gone, should not trade anymore for that day. It's going to force you to be more choosy. Trust me. All right, let's look at a crude oil chart. This trade set up later in the morning on crude oil. Now, Most of you know that crude oil can be fairly whippy and volatile. It's not for everybody. And sometimes it has some nice moves, sometimes it doesn't. This was another deep bar probe. Let's look at the setup here. Here we can see that the trend was down. Our guidance dots are short. Right in here. See, all the guidance dots are short. The trend was down, and we have a series of probes where the market was descending. Now, right here, between 10:30 and 11 o'clock, it went into a very nice, methodical, deep retracement, like such. We draw a retracement line at 45 degrees, and it comes all the way up here. We have some terms for this, mastery trade. Line in the sand is another one you hear. A line in the sand trade is where we come up and we challenge the guidance dots, in this case short. You can see that our retracement line, this is called a deep bar probe because the bars turn blue even though we are in a downtrend. Now, there are a number of different entry techniques on this short setup right here. Some aggressive traders, just like the other one that we saw on 6E. Oh, I don't have Chart Trader on this. Standby. Thought Chart Trader was on all these puppies. There we go. Okay, we're in Sim. It's the weekend. Markets are closed. Some aggressive traders will short when a market comes up at or near the guidance dots. That, of course, is the most aggressive entry, right up in here. All right? And the stop is located above the swing right in here. So from a risk perspective, you're shorting, so you put a buy to cover stop right above here. So this trader is only risking about, what is that, 5 ticks. 4, 5, 6 ticks right here. You're entering as it hits the guidance dots. The risk, of course, in entering when it comes up here, and this is what makes some traders nervous, it's kind of this old theory of catching the falling knife. In other words, the market is still moving in the opposite direction, which in this case is up, and we're looking to short it. So some traders aren't comfortable doing that. It's clearly the most aggressive and least risk entry of the trade because the stop is the tightest, and in the event that it comes and chops around and takes that stop out, you're just going to lose 5 ticks. That's as simple as that goes. Most traders, however, need to be convinced that the market is going to begin to sell off again, or a resumption of selling in the downtrend. And so other traders would wait until the market breaks the retracement line and starts to descend and drop again. So these traders would be looking to sell a breakdown in this area here. Can everybody see the difference in the entry techniques? I wouldn't consider any of these to be entries, simply because, and this is where some traders get into trouble. If you draw your retracement line too aggressively, you're going to get sort of faked or sucked into trades that you may or may not should have been taking. In other words, what I'm saying is this: I've seen some more aggressive lines being drawn very like that, or some other, like very steep. Now, I'll just because I see your question there, Akeem. If you happen to draw an aggressive retracement line, okay, let's say that you drew this aggressive line like this, and you shorted this market. Let's say you got filled, somewhere in here. Let's move this over. Let's do a hypothetical on this because there's a question about it. Can you see that the swing was right here near this band? All right. As it broke and moved in your favor, and this is a quick little technique that you can use on any of your trades, by the way. Here, let's talk this through for a second. Let me take this other entry off for just for a second, because this is something that I think actually could help a lot of traders. Let's say that you draw an aggressive retracement line like this on this yellow bar probe. You see that it hits this band at 97.08. When it rolls over and breaks this retracement, this aggressive retracement line that you've drawn, and this could be anything. This doesn't have to be crude oil. It can be any instrument you're trading. Say it's one of the equities like ES. You get filled here. Okay? Your initial stop would be above this swing. You're short, so it's a buy to cover stop. Right above that swing. See it? 97.08. Your stop's going to be right up here, a tick above that swing at 11. So now you're risking about 8 ticks. See it? Now, this market starts to roll over and right in here, chops around your entry and starts to drop down right here. So it's starting to move in your favor. And at this point right here, you're up about, let's see, 03. I don't know, 8 or 9 ticks maybe? Not quite 10 ticks maybe? What do you do when this market drops 10 ticks in your favor? You're short from 97.03. Your initial stop was at 11. You had this very aggressive retracement line that was broken. You're short, and it's moved about 8 or 10 ticks in your favor. What is the immediate thing you need to do in this scenario right here? Immediately. Any trade, any instrument, any time of day, you're looking at this setup. What do we need to do right at this point? Get the stop down immediately. Now, we can see that, and our hopes and expectations when we short this are that it's going to come at least to here and check this. So you might be looking, you might even fade that by a couple of ticks and put your buy to cover stop down here, saying to yourself, well, that puppy goes down there, I'm going to get out, right? Let's see what happens. We take our stop. You can take your stop down to right at your entry, a tick behind your entry, or a tick or two in front of your entry. This stop loss right here will assure you that no matter what happens on this trade, whether it goes to here, here, or to the moon, that you're at least going to make 2 ticks. Okay, the market comes down, it chops around, comes back up, and stops the trade out right in here. So it didn't come down here and fill your target. It didn't break down and continue and give you a nice runner. It popped down here, gave you 8 or 9 ticks, and then came and stopped you out, and you still made 2 ticks. Does everybody see that? This little technique right here, and it's not complicated, and the challenge really about this is that sometimes these little pops of 8 or 9 ticks happen so quickly that what we see is a lot of traders then, maybe you're distracted looking at another chart or something comes up and you're kind of not paying attention to it, that you've left your stop all the way up here and the thing pops down in your favor, you forget to move it, and then boom, it comes all the way back up and takes you out. And you get the full stop out. Does that happen to anybody? Forget to move the stop, it jostles around and then comes back up and takes you out for the full stop that we didn't remember to aggressively take that down there like that. It's okay. If that happens to you, you just have to remember, I know that happens. I know it happens. It's okay. And it's a lesson learned. I mean, that's what trading's all about. When you get in, you take the risk, you take the trades, and the thing stops you out. You say, "Wow, the thing came down. I should take this down right to break even, or right where I got in. I could have made a couple of ticks, even though I stopped out." Okay, good. Everybody sees that, right? We're all going to do this next week. Let's get back to our other deep bar probe here. Okay. All right. So we did or we didn't take that trade, but the market's retracing. We see it's retracing. And we had a couple of different entries up here at this challenge of the line in the sand at the stop dots. The aggressive entry was up near the guidance dots here with a very tight stop, buy to cover, above the swing. This trader's risking about 4, 5, 6 ticks, plus or minus right here. See it? The less aggressive entry, still valid and very good entry, is the trader who wants to be convinced that that there is some return of selling, and that you're not going to short it until this break of this retracement line is taken out to the downside, which would have been filling you short, excuse me, somewhere right in there. Now, you can see that this trader who shorted this area, sort of catching the falling knife, so to speak, a little bit tighter stop, less risk, had a 9-tick entry over this trader who waited here. But here again, you can't focus on that, because what it comes down to is what you're most comfortable doing as a trader in terms of your risk. I'd say both are very good entries. And if you're the trader who entered on the break of the retracement line, if you feel that this 42 stop was too loose or wide for you, you could have you could put your stop in here. Now you're risking about 7 ticks, and you only had to risk this amount, whether the stop was here or your initial stop was here on this trader, because you can see here, shortly after you entered this trade, the market moved immediately about 12 ticks in your favor. Can you see that? And we know that when the market moves 12 ticks in your favor, we're going to take our stop down very aggressively. Yes, we all know that, right? We just looked at it over here. We've looked at it several times this morning, okay? All right, so the market's starting to drop, and we've said here, let's back up a little bit. Just 1 second. We're going to apply the principle of leverage to our trade. So we're trying to put on 2. Now, by the way, when we say 2 contracts or 4 or 6 or 8 contracts, however many you can put from a risk point of view, put on, because you're doubling your risk. What I mean by that is this. So the trader who put this on and is risking 5 ticks with 1 contract is $50 of risk on the stop, yes? The trader who puts 2 contracts on at 5 ticks is now risking $100, yes? The trader who put this stop here and the initial stop up here, and you're risking 14 ticks, on 1 contract you're risking $140. The trader who puts on 2 contracts on this short and puts a stop up here is risking $280. All right, so I just want to level set everybody's expectations. When we talk about the concept of leverage, which is 2 or more contracts on a trade, you're doubling or tripling your risk as well, risk of loss. Now, question for the team before we move on with this trade. What is the most money that you should risk in any trading session? Risk meaning lose. What is the most money that you should risk in any trading session? Now, those of you that have been with us a while, you should know that number. Those of you that are maybe visiting or new, you may or may not know that number, so that's perfectly okay. But if you've been with us a while, you should just pop right in your head. You should know this number right at the top of your head. How much money per trade or per trading session? Any trading session that you go in and you risk live money in the futures market, or any market for that matter, and this is a number relative to your trading account size. I see 2%, 3%, 2.5%, 3%, 6%. Holy smegaboni. Ken, that's a lot of risk. 3%. Good. So risk is relative to your trading account size. It doesn't matter what you trade. It doesn't matter where you trade it. This is a rule of thumb that I am imploring everybody in here to utilize for proper risk management, and this is what's going to keep you in the game for a long period of time. Do not risk more. It is our strong suggestion than 2, 2.5%, 3% of your trading account. Here is why. There are going to be times when you're going to experience drawdown. Drawdown is a sequence of losing trades where you just can't seem to get in sync with the market, right? The market's moving around, you get stopped out. Market's moving around, you get a bad entry, you get stopped out. You just can't seem to get it. You try a different instrument. You try this, you try that, you try something else, and there's several days in a row where you just can't seem to nail it and you take some losses. Now, the thing we don't want to do is we don't want to ever increase our leverage when we're in the process of a drawdown. Please do not do that, because that's going to accelerate and exacerbate your losses. What you need to do is cut down your risk. Find out what you may or may not be doing right or wrong. Try to correct it, and do not increase your risk or leverage until you have that under control. Because look at it this way. If you start risking more than 5%, 6%? 10% of your account? How many losing days would it take if you risk 10% of your account in every session and you get into a drawdown period? Do the math. 10 days. 10 days would wipe you out, right? I know. Many years ago, many years ago, I blew up my share of accounts. I know what that's like. I've been there. Trust me, I know what it's like. It's no fun. Absolutely no fun. That's the tough, risky, scary part of this business, right? So if you say to yourself, well, I'm not going to risk more than 2.5%, 3% of my account, how many losing days in a row would it take at 2.5% to wipe out your account? How many consecutive losing days with no winners at 2.5% to wipe your account out? Anybody? 40. 40 trading days, which would be what? How long is that? 5 trading days, 48 weeks, 2 solid months of losing money every single day and having no winners in between. What is the statistical probability of that happening? That you would have 40 straight consecutive losing days with no winners in between. Statistically, it is possible. It is possible. There's no question about it. You could get into an incredible slump, and that could happen. But in all likelihood, within 2 months, 40 consecutive trading days, there's probably going to be some winners in there, yes? What you're doing is you're giving yourself the, being hit by lightning. Yeah, it'd be the same as being hit by lightning, Bruce. See, this is what you want to do. You want to put the odds in your favor. You don't want to unduly put more risk into an account. So this comes to leverage. In the trader who took this trade right here and risked $280, what you need to ask yourself is relative to my trade account size, can I afford to take a $280 hit and put 2 contracts on crude oil and risk 14 ticks a contract? That's what this comes down to. And you have to know before you take the trade whether you can afford to take that risk. One last thing on this is you don't want to put all your risk on one trade. If you said 280 is what I can risk for an entire session, then you shouldn't really put 2 contracts on this trade, right? Moving on with the trade. Enough about risk management. You have 2 contracts. Let's say you got filled either here or somewhere in between. Where would be the first place that we would look to take contract the first contract off potentially and take our profits on the first part of the first leg of this trade? Just take a look at the chart. Where would be a place where we would look to take potential profits if we put 2 contracts on here? Profit-taking area. You can just type in a number where you see support or resistance in a prior area to peel one off. That's what we call it, peel one off. Ken says 97.10. Okay, where else? 97.20, 97.10, 97.15. Okay, good. Good, excellent. We can see right in here, and this is just visually pretty easy to do. Can you see where we have an area where the market found support and resistance right in this line, in this band right in here? See it? Now when you see that area, this would represent a good target for contract number 1. Buy to cover, excuse me. If you really want to be filled down here, we probably wouldn't want to put it down in here, although it might hit it. We want to fade it when you buy to cover by at least a couple of 3, 4 ticks, yes? Market has moved precipitously, 5, 6, 7 ticks in our favor. We take our initial stop down, close to break even. Market starts to move, chops around, comes down, and hits the first target. We take the second stop off of here because we only have 1 contract left on, yes? And we began to trail. Now, by the way, it was a good thing that we took that contract off because look what it did. It touched it, and then what does it tend to do when it hits support resistance areas? Right? Retraces. Now, when this bounced and retraced, this is why you want to give your stop a little bit of wiggle room, because it's quite possible that this retracement could have come all the way back up to your entry. That's some drawdown we don't like, right? That's some drawdown we don't like. I mean, there's nothing worse than being in a trade. You know, it's up 50, 60, 70, 80, 90, 100, 120. You're feeling good. Life is good. It hits this target, bounces. Oh, no. Oh, no. 80, 70, 80, 90, 90, 100. Oh, 10, 20. You're only up 20 bucks. Don't you hate that? I know I do. Anyway, all right, so the market comes back up, retraces, takes a chunk of your trade away, but it's okay because you're already out of one, and you got 2 ticks in this one, so you got what we call a free trade, and you're looking for that runner, right? You're looking for the runner. All right, so here we come. We roll over. We take out the support. Here's our stop dots starting to descend. Here are our the red stealth. Some traders use split the difference between the trailing stop dots, which is looser, and stealth. So let's go right in the middle. Market's descending, you're trailing your stop. Market's descending, you're trailing your stop. You're in between the stop dots and the red stealth line here, trailing the movement of the price. This is oscillating down ABC, 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 dropping in your favor. You're following right along with your stop. Moving in your favor, dropping the stop. Moving in your favor, dropping the stop. And this is why having two contracts is nice if you can do it based on your risk profile. In all likelihood, it probably took you out somewhere down in here. Somewhere down in there you got taken out. Because of this concept, leverage of 2 contracts allows you to do this, and you can see very clearly by this trade. You can take one fixed contract out at a support resistance area, and this is the first leg of the trade, allowing you to bank some profit. The second contract, in most cases, not all, but most cases, is considered the runner. That's the one where you want to let it run. You want to let it go, go, go as far as it's going to go. So 2 contracts allows you to take advantage of both approaches, fixed target and the runner. Leg 1, leg 2. Now, if $10 instruments are too pricey for, if you have the initial stops, a lot of times are 10 to 12 plus ticks. So you can see that on a $10 instrument, you're talking about $100, $120 of risk per contract. Whereas if you went with a $5 instrument, say like the dollar index, DX, NQ, NASDAQ, or YM, mini Dow futures, $5 contracts, you could put 2 contracts on and have the equivalent risk of one $10 contract. You know, a lot of traders say, well, I can't make money on a $5 instrument. Well, I beg to differ. I know a lot of traders, a lot of them have been with us for a very long time, since the very beginning, and they trade the dollar index. Excuse me. A lot of NASDAQ traders, and they worked it up to where now they're putting 6, 8, 10 contracts on it a clip. You know, they'll peel half of them off, they'll pull 5 off at a target, and they'll let the other 4 or 5 run. You know, they've really leveraged up. They learned that instrument, and they're comfortable with it. And they start off with 1 or 2, and they work their way up. The whole key is to be able to develop those trading skill sets so that you can apply them to any instrument. That's the key. So let's see here. Leg 1, let's say you got the later fill. 97.28. And your first pop was down here at 12. So that's 16 ticks. And then leg 2 was from 28 down to 62. 28, 72, 62, 30, 38. So that second leg was 16, 66. 66 ticks on the second leg, short, which is that one right there, and the first leg was 16. So the total would have been 12, 82 ticks. How much money was this trade worth? The trader who got filled on the trend line break on the deep bar probe on the challenge of the line in the sand trade, you got filled at 28, leg 1 was 16 ticks. You took it out at the support area, it was a good target. Second one was the runner, 66 ticks, total of 82 ticks. On crude oil would have been $820 trade. Right, that's right, $820 trade. Now, I don't know what your profitability or goals are for the day, but I think a lot of traders would be very happy with an $800 trade. That would be your one and done. That could very possibly be your one and done. And I'll tell you, if you're watching, like we said, if you can get two nice screens, get yourself a couple of nice screens, put maybe 3 or 4 charts up, and train your eye to scan for trades and learn these setups so that all you need to do is put 2 contracts. I'll tell you what you could do is if you want to trade $5 instruments, go ahead and put up the dollar index, NASDAQ, YM. I'll tell you, YM and NASDAQ have just had incredible moves lately. You saw Friday, most of that last week, YM was leading the whole market up and down. It was the leader. I'll tell you another one you can look at is 6B. 6B is 6 1/4 a tick, and sometimes it has nice movement. Here, let's take a look at a 6B chart. 6B is 6 1/4 a tick. So you're right in between. It's not the $5. It's not the $10. 6 1/4. Here you had a nice short here. Look at this nice short. Came up, rolled over, broke down. Get some nice movement on 6B. Let's take a look at 6A. 6A, the Aussie, is another one. 6A, by the way, trades in the very nicely, usually in the Asian session, which is our evening time here. So 5, 6 o'clock Pacific. So let's say some traders, you work during the day and you want to look for trades at night. 6A, the Aussie futures, is a good contract to look at. Here we had some nice short setups. Broke down out of the zone. You had a nice little trade set up right here. If you're sitting around in the evening, just relaxing, you want to take a look at something, and maybe even you just practice on it in Sim. You don't even have to take these live and against your real account. Let's say you're just kind of looking for something that's moving, so you can practice trade entries. That's a good thing to do with real-time data. Here we had another nice short setup, kind of chopped around here. We were in a downtrend, 6A, Aussie dollar futures, $10 a tick. Here's a couple of nice retracement trades. We look for these right into the upper band. Rolls over, a couple of nice retracements. So what you're doing is you're shorting here, right? When the market comes up here, you're selling it. Oops. Yeah, right up in there. You're shorting, retracements up into resistance. Put your stop above the band here. Trail your stop on the runner, right? Trail your stop on the runner. Just get in there and practice. Markets open at, I think it's 3 o'clock Pacific on Sunday afternoons, and they run all the way until Friday, 1 o'clock Pacific. So you got 24 hours. You got all these markets. Put yourself in Sim and practice some of these retracement trades. Then when live trades come in the market that next week, you're all set up. You know exactly where to get in. Put 2 contracts on. Leverage yourself if you can. Only if your account can afford it. Take the first contract out of the fixed target. Buy to cover, and then get your protective stop down. Drops in your favor. 2 ticks in front of your entry. Right? Trail the stop on the runner. Very simple principle. Put those 2 coins on your desk. If you want to give yourself a little bit extra room, put 3 coins or 1 coin. The whole idea, you don't have to do that forever. All you're trying to do is train yourself to be very cautious and careful. You're looking at those coins and you're saying, oh, I'm giving myself 2 shots at this market today. Maybe give yourself 3 and allow yourself to have 1 loss. You can have 2 winners and a small loser. That's okay. That's how you apply discipline. Eventually, you won't have to put 3/4 on your desk. You will know that you're only going to take 3 trades, right? And one last thing, and I've said it earlier, please try to not put too many charts up. I see some people have 6 and 8 more charts. Try to get it down to just a couple of 3, 4 at the most. Find those instruments that you like to trade and get to know them like the back of your hand. If you get to know them like your best friend or partner, spouse, I'm telling you it's going to pay off in big time in spades for you. All right, we're going a little bit over, but we got a late start. I'm going to